This is the Rocket City Retirement Show with Cris Wallace. Cris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Cris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Hi, I'm Luann Fulmer, and I just want to welcome you to the Rocket City Retirement Show with my friend and certified financial planner, also financial advisor, Cris Wallace at WG Financial Group. He is president there. And then also joining us again today is Graham. He is a relationship advisor. And then we have something exciting to talk about today that he has recently done. So they are here today to give you some really good advice about retirement planning. Now, here is the phone number that you need. This is how you can reach out to Cris, complimentary, 256-937-2010. You may call or you may text the word visit if you like to text to 256-937-2010. Remember, this discovery visit is complimentary. Please remember that because it's so easy to get in and talk with Cris and the team at WG Financial Group. Also, follow us on Facebook. Just search for WG Financial Group 256 because throughout the week, anything that might go on, anything pertaining to the show, Cris will add things to Facebook. So it's a really good idea to stay connected with us that way. Remember our motto, plan, retire, play. Look at us online, too, at WG Financial Group anytime. And our show is available on Spotify and Apple Podcasts. Search for the name of our show, Rocket City Retirement Show. Hello, Cris.
Hey, Luann. Good to be here.
Thank you. So excited to be here with you again. And Graham, glad to have you back.
Hey, Luann. Yeah, it's good to talk to you again. It's been a while.
It has been a while. So that's our positivity. You know, Graham always gives us positivity, WG Positivity. We're excited that you're back on our show with us. Cris and I have done a few alone. So nice to have you back. But you've been a busy guy.
Yeah, it's been a busy couple months. I think we're going to talk about that a little bit, but I was holed away for a little bit there, grinding out the textbooks and studying for a bit. But yeah, just finished up the CFP exam a couple weeks ago and was able to pass that. So that's been super exciting. But yeah, that was a big reason for, getting some extra study time in and getting in those books.
So Cris, You have another certified financial planner on board.
Not officially yet. There's still a couple of things he has to still yet do in terms of filing. And I think you just filed your last thing that you're supposed to file, which is, I think, the ethics.
Yes.
Okay.
Yeah. So it'll be probably a few more weeks. They have to get the official scores out that they send. You get a preliminary pass, and then they'll send the official ones out. So I can't actually call myself that yet. But in a few weeks here now, we might have to add that to the intro card of the show.
Oh, love it.
Yeah, I think it's kind of a big deal for Graham. That's one of the reasons why he hasn't been on the show is his main goal was to pass that test. And so what we did was we allowed him extra time to study. He handles some of our client base in terms of servicing them and being their relationship advisor. And then so, having him take this last few months pretty seriously was kind of a big deal because I remember in 2016 going through it myself.
Yeah, I do.
That last few months is really critical that you hit the books, you hit the practice tests, and that's what I'm sure all of your advisors that you were working with through the CFP curriculum were probably communicating to you. So you take so many practice tests that your eyes bleed, and your mind goes numb, and you wake up in the middle of the night talking about estate planning and tax planning, and so Graham, I just as far as the test itself, like overall, you've obviously taken the insurance exams, you've done the 65, the Series 65, you've done tests in school. How does the CFP compare to some of the tests that you've taken really throughout your young lifetime at this point?
Well, the CFP is an interesting test, I think particularly because of scope. A lot of tests that you'll take in your lifetime, whether that's a history test or something like the Series 65, to be a licensed investment advisor. They're pretty narrow in their scope as far as you go through a lot of topics, but it's all in one thing. So with the 65, you're talking about primarily investments and then, some kind of compliance sort of state regulation things. And it's a pretty tricky test in its own right. But the scope is much more narrow. The CFP is very, very, very broad. And I think that's what makes it really tough as a test taker, also as people teaching you how to take the test, because they don't really know what they're going to throw at you. There are times, where they've told us about certain questions that get tossed out there that, most advisors would have no idea what the answer is to, because it's a very specialized, probably homeowners insurance agent question that, we don't really deal with that side of, at least in that great detail. But the overall scope is really what makes it so difficult. So you kind of get a little bit of an expertise, a little mini expertise in a ton of different areas. But it goes particularly deep in, taxes and estate planning and all of that.
Yeah, I think the best way that I described it to my kids was they were still in high school at the time. And, I'd taken the insurance exam to 65, just like you have as well. And I explained it like taking a final exam with all of your courses in one exam.
Mm-hmm.
That was how I best described it.
Yeah.
Like when you go sit down to take your, like Graham had mentioned, like history, it's all on history and you kind of know what's going to be on history. Well, with the CFP, you may have these questions that are literally like a paragraph. They're 2 and 3 and 4 sentences at this time at times. And you're trying to decipher, what are they asking you in this question? You have to think comprehensively with the question. It's not, it's not a true false. It's comprehensive. And then if I'm not mistaken, Graham, I think in each section, there's 2 sections, at least it was when I took it. They have a very comprehensive situation where you have to like math out a couple of things and think through it. It's like a multiple question where you're actually working on kind of like a mini case study within the exam. Did you have that as well?
Yeah. So there'll be it's random, so it's not guaranteed, but at least, on a lot of practice exams, and I definitely saw some of these, that case studies do come up. And yeah, they're essentially, it'll give you maybe a couple pages of reading followed by a cash flow chart, what these people are spending, what they're making, a balance sheet, which is, what their assets and liabilities are, kind of a net worth thing, give you information about their plans at work, about their investments, and, getting into the actual technical stuff like alpha, beta, trainer, all that, kind of stuff that you don't necessarily see on a day-to-day basis. And then ask you usually 10 to 20 questions about that information. Yep. And so, yeah, it's kind of like doing a little mini financial plan in the moment. But they threw a lot of stuff. I mean, there are things like analyzing estate tax returns on there, which prior to taking the CFP exam, I had never seen the 706 estate tax return. I don't know that I will see a lot of 706 estate tax returns in my career because, we don't prepare taxes, but they're teaching you things that you don't even necessarily do. There's stuff that they will teach you how to do that, again, at the end of the day, you're not technically even licensed to do, but they want you to understand it. It's not necessarily about total application, but when you're sitting down with a client after that and they're talking about this kind of stuff, you will know what they're talking about, and you can, help them with different things that you might not be able to speak to otherwise.
Yeah, I think when it comes to this, the CFP exam and being a CFP, certified financial planner, and obviously a financial advisor as well, a lot of what we do is about pattern recognition. Everybody's situation is going to be different, but there are certain things where you can start to recognize patterns and have an experience and exposure to the state 706. What you're talking about there. Obviously, that's not something we see all the time, but it's good to be familiar with that stuff. We've been told by people that have come in to see us as, their advisor, their broker says, "Oh, we don't do this." Well, we don't either, but we're familiar with it.
But you know about
exposure,
it,
right? And I think this is where Graham literally being fresh out of the books is kind of nice, and then me having a fresh head full of gray hair is kind of a nice match. You got kind of the textbook. That's what has just taken place with his test. And then also 20 years of experience at the firm as well. So it's just kind of a nice mixture. Super proud of him. I just want to say that. I get asked a lot of times if he's my son. He's not, but he's kind of my at-work son to some degree. I'm sure his dad doesn't want to give him up. His dad's awesome as well. He's got great parents. And but as far as us at the firm, we're like super proud of him. And he did an incredible accomplishment at his age. And really just what he's done in the past 2.5 years and working at the firm. And he's done everything we've asked him to do and then a whole lot more.
And more, yes.
Yeah, and a whole lot more. So we're extremely proud of him, and glad to have him back on the radio show as well. And I'll kind of move into a little bit of a market update.
Can I just say congratulations to him too? Yeah, Graham.
Well,
So excited for you. Congratulations. What a big undertaking. And like you said, such a broad scope to study for, and then to know have to know so many details. So that is quite an accomplishment for both of you guys, So
yeah, well, thank you, Luann.
Yes,
I think
you're welcome.
The real studying motivation was to get back on the radio and talk to you again. So that's all I needed.
Oh, thank you so much.
That was the real motivation. Oh, boy.
Yeah, just to be back on the air.
It's getting
I don't
deep
know
in
about
here.
you, Graham. I'm not sure about that part of it, but anyway,
it's
so
getting
proud
deep.
of you. Yeah.
Yeah, Graham has a lot of fans on. We posted that on Facebook, and
He
man,
does.
he got more likes than I think anything that we've ever put out there. And
Wow.
I'm like, well, I'm kind of jealous.
Yeah. Oh no, Graham, he's
Graham.
jealous of you.
maybe meta platforms just like me. Maybe Mark Zuckerberg himself just kind of push my stuff to the top.
Yeah.
Yeah, that's it.
Yeah.
You got a relationship going on or something. I don't know. So I do want to say this, Luann. We were talking about this pre-show. This is our 365th airing.
Yeah.
So-
we have had really, truly a year's worth of shows that we have done that have
It is.
aired. A year's worth. Yeah. Crazy.
We have been in people's ears for a long time.
Yeah.
Graham said today that you can literally listen to one show per day for an entire year.
For an entire year.
Of the Rocket City Retirement Show.
Yep.
Yeah. So, all right, let's hop into a quick market update.
Okay.
S&P year to date's up about 23.5%. The Dow is up about 15. The NASDAQ is up 25. And the aggregate bond index is up only 1.4%, but yet still positive. Finally, after about 3 years, we finally got a positive bond market moving at this point. I want to talk a little bit about the election. We didn't really get into that because we really haven't recorded since the election. So if you remember, Luann, when we recorded,
It was
the day of the election.
right?
It was election day.
Yeah.
And then the following week we had to do a rerun due to some traveling that I had going on.
Yeah.
So, all right. So I was wrong. I have to admit I was wrong. I did think that Donald Trump was going to win. I truly did think that. But I thought that they would stretch out the election, for a week.
I did too. I did.
Yeah. I thought that we would know maybe by the next show. I wasn't sure. And I think I said it would be stretched out for several days. And man, we found out the night of. So
the night of, middle of the night. Yeah.
Yeah, about 2:30 or so in the morning. People were probably tired, staying up watching it. I know I stayed up and watched it. It was kind of fun to just kind of watch. And
I watched it with one eye open. Yeah, literally.
Yeah. So with that, I do want to I just want to remind everybody not to get overconfident. I mean, I know there are a lot of Trump fans out there today, and just a reminder: don't base your retirement plan on the sitting president, regardless whether Democrat or Republican. Our best advice for families and individuals out there is to make sure they have a plan, and not really to bet on investments with this who is going to be the sitting president. So don't get overconfident. The other thing that we saw happen, which was a little bit of a shock, but not completely, since around the election, we've seen the 10-year Treasury yield start to rise again. Now that's actually bad for bonds, and that's why the return percentage in the ag index is only 1.4% for the year. It was actually higher than that. But we saw the 10-year yield go back up, so that's put a lot of downward pressure on bond prices again. And I think that there's a couple of reasons why this is happening. I think investors are, in the short run, probably a little bit leery of the potential tariffs that may come about. I think that's one thing. I do think, long term, I think that could be potentially a good play for a lot of other reasons I won't get into, today. But I believe that that's one reason we've seen the 10-year yield rise. But probably more importantly is inflation has it's kind of become a little bit stubborn, and it's kind of plateaued out right around that 2.5% area. And we've seen month over month, we've seen it ticking up just a little bit. So I also believe that the investors out there today are a little bit concerned that inflation's not coming down as quickly as it once did. And I believe that the market is kind of repricing in the Fed's not cutting rates as aggressively as they once said they would. And you kind of got that message a little bit from some comments just a few days ago. But you can also see it in the Fed Fund futures as well. If we're looking out right now to the 12/18 meeting, which is the next time the Feds will meet and make the announcements on whether or not they're going to cut rates, leave them the same, raise rates, whatever, right now that the cut percentage is now 60-40. So a 60% chance that we'll see another 25 basis point cuts. But that's actually down from like 80 to 90%. So it was a lot higher. And now that there's been some, I love the word scuttlebutt. I just think it's just kind of such a naughty sounding word, but it's just kind of a cool sounding word as well. There's a 60-40 chance now that they cut rates, which, it wouldn't surprise me if they hold, to be honest with you, with inflation kind of getting a little bit stubborn. So anyway, that'll just, as we get closer, we'll talk more about that and what's going to happen. So main message here is, just don't get overconfident. We want to make sure that people that are preparing to retire, those who are actually retired, we want to make sure they have a plan. And, regarding having a plan, I found a study, and I think I saw this on X, formerly Twitter, where there was a TIAA study, a financial literacy study done. And it was pretty interesting that only about half of the people that answered questions passed. And I thought that was, I thought it was pretty eye-opening, as a matter of fact. And I'm looking back at the years here, and it's gone from like 2017 through 2024. Mm-hmm. And it's really always been about 50%. So that was a little bit shocking. It's dropped off just a tick here in the last 2 years. But it seems very, very shocking to me. And what was really shocking is if you look at the silent generation and the baby boomers, they only about 50% of them passed. And those are the people that are literally on retirement doorstep or in retirement. And they're going on this journey that they've never been on before, called retirement. And they scored only a 50%. I don't know if did you see that, Graham, in the study?
Yeah, they went obviously through different generations, but I think the silent generation and, baby boomers were probably the most surprising to me, because there were questions in this study that they asked them about things like Social Security, Medicare, life expectancy, those types of things that you're kind of at the stage in life where you're probably getting really close to using those programs or are already using those programs. So, when you're talking to a Gen Z person that doesn't totally understand Social Security, they still should probably get some literacy about it. There are things that are important to know about it from a young age. But if you're knocking on the door, you're a year away, 2-3 years away, you should definitely understand Social Security and Medicare by that point, because you're actually about to make a big decision about it, or maybe you already have.
Right. You mentioned Gen Z. They scored a 28%. So that would be like my daughter taking the test.
Yeah.
And this is embarrassing to say because she's my daughter and I love her to death, but she wouldn't have scored a 28 and I'm her dad. That's embarrassing. I got work to do.
You got to train her.
Yeah, Social Security workshop at home tonight.
Yeah.
There you go.
She'll love you for
When
that.
I go home and get the slides out. Come on, right around the dinner table.
Yeah, here we go.
Yeah, here we go. Pay attention. So, So yeah, I found that pretty interesting. Just a couple of the questions here. So this is one of the questions. So, which statement about Social Security is false? The amount someone receives in Social Security benefit depends upon his or her earnings during the last 2 years of retirement. Okay. Or last 2 years of employment. I'm sorry.
Of employment. Okay.
That's the actual correct answer that's actually
true.
false.
Okay.
The other ones that are true is a worker receives Social Security benefit payments if he or she becomes disabled before retiring. That's Social Security disability. So yes, we know that's true. Social Security benefit payments will continue as long as an individual is alive, no matter how long they live. Well, that's true. And the other one is don't know. I guess that would be true as well. But the one that is actually false is it's not based on the last 2 years. So it's
based on your whole career earnings, right? Your life.
Well, it's based
earnings.
on it's a nasty calculation that they go through, but it's definitely more than the last 2 years.
I believe it's about 30 years. I think it's your high 30. But yeah, there's a ton that goes into the calculation.
Wow.
We would bore everyone to tears if we read through that.
Yes, you probably would. Yeah.
Well, and truthfully, I'd have to look the calculation.
Yeah, I would too.
It's like a nasty, gnarly calculation. So here's another one that says, Susan worries about living a long life and running out of money. What's the best way to address that possibility? One is to buy annuity. 2 is to buy life insurance. 3 is there's nothing she can do about it. And number 4 is I don't know.
Have a plan. She needs a plan. That's
she
not
needs a
in
plan. But the correct answer to address longevity here is to buy an annuity. That's what the answer is.
Okay.
Right. And if you're going to die early, if you're worried about dying early, so like we got younger families out there that listen to the show and they have debt and kids and college and all of that to worry about, that, they should look at buying term life insurance is what we would tell, a young family today. So die short, life insurance, live long. That's, usually the job of an annuity. And there's arguments. I know there's people like, I don't want to buy an annuity. I can invest and, make this amount of money long term. Well, yeah, we can argue about that. But in these choices here, these were some of the choices. So
That's
again,
good.
kind of a unique study that it's good for people to know these types of things. And as I was reading through this study, I was thinking to myself, I said, you know what, this is exactly why we do the show. I mean, we do the show to talk about stuff like this and to teach people over the airways the best way we can. And those who need help actually, come in and give us a call at 256-937-2010. They set up their discovery session if they want to talk a little bit further. The do-it-yourselfers they're do-it-yourselfers. They're going to do it themselves, and we don't discriminate. We give information to everybody over the airwaves, and we just want them to make a good decision. One of the last things I want to touch on here as we come near the end of the first half of the show is one of the things that we ask about in a meeting with a client, and we do not do this at the office. And you mentioned homeowners insurance a few minutes ago relative to the CFP exam, and there's questions on that because they want us to be prepared in case they see a situation where we may be able to make a recommendation. So homeowners insurance is definitely something we ask about. One of the things that I personally tell people that I meet with their families or individuals when I first meet with them is, number one, if you've been with an insurance company for a long period of time, say 3-4 years, it's time to probably requote at this point, simply because rates have just gone up dramatically over the past year, 2 years. Auto insurance has gone up nearly 20% or over 20% in the last year. When it comes to homeowners insurance, there's also the issue of people who went out and upgraded their home by adding rooms or building on additions or just redoing their house in general, i.e. adding value to the house. And now there's the potential, that's what this article was referencing here, that there's, and it's from, I think Grammy sent it to me, it's from Spectrum News in Southern California, looks like. But take the point, don't pay attention to where the article's from. Take the point here is that you or your family or somebody in your family may have updated or upgraded the house, and now there is a possibility you could be underinsured. So we think it's a good idea to contact your homeowner's agent and just make sure you've got adequate coverage. The other thing that I'll say with regards to insurance in general, specifically like auto insurance, this is another question that I'll ask people is, what is your auto deductible? And some people will say, oh, it's $250. Well, that sounds great that if you get in an accident, you're only going to have a $250 deductible, but having that lower deductible, just like it does with health insurance, just drives up the cost of your premium. So if you've got money sitting in savings and enough to cover a large deductible, carry a higher deductible. It's going to make your premium cheaper. I'm the type of person I'm going to bet on myself as not having an accident. So I keep enough money in savings to be able to, cover that larger deductible. I personally carry $1,000 deductible so that my policy is a little bit cheaper. So if you're listening to the show, that's just an easy way that we kind of try to help people out and kind of point some things out. And you'd be surprised because we do have internal referrals for our clients that work with us that we send them out to, just the money that can be saved just in your home and auto. And, having that relooked at and requoted, we feel like it's a really good idea. And there's things in general that we believe that you should, take a look at just to save yourself some money. The other thing, last thing I'll touch on here when it comes to homeowners and auto insurance here is we are strong believers in having an umbrella policy. I have one. And this is where if you run out of coverage essentially with your home or auto, or maybe you're in a lawsuit or something like that relative to a car accident, then your umbrella policy kind of kicks in after after those limits in the auto and home policy are exhausted there. So it's just additional coverage that sits really over top of your home and auto. We feel like that it's important today in the litigious society that we live in, that families take a strong look at having that umbrella policy in place. And again, don't call us. You can call your home and auto insurance agent. They're glad to take care of that. It's just, our job when we're looking at things from a holistic perspective that we talk about on the air. We talk about it in the meetings. When people come in and start, just having discussions with us about their retirement plan, we're literally looking at all of the areas, just like Graham was mentioning, that's covered in the CFP. We want to touch on all of those areas. We don't need to be an expert, but we want to be able to say, hey, did you know you can probably save a few bucks if you take a look at this? That's just part of what we do for families in the Huntsville area. So, Graham, did you have anything else you wanted to add on the insurance side? I know you and I are kind of looking back and forth at each other, and I did a lot of talking there.
Oh, yeah. No, there's, one more thing I'll kind of add just to give people a little bit of perspective. I think it's, what you're saying about talking to your home and auto agent and checking on that is very important. Some of the statistics they showed in here just quickly, that since 2020, the cost of home construction materials has increased 35.4%, cost of labor up about 30%. And then there's other things, that they mentioned, like if you own an older home, there's a decent chance that, there could be some new building laws and regulations that could also drive up the price of having to build something that's a bit newer. So especially, we'll meet people and we do inquire about the home and auto insurance. And it's not uncommon to hear someone who's been with the same company for 20, 30 years.
Oh, yeah.
If you've also been a homeowner for a long time, there's a decent chance that you haven't really looked at it too closely, because it's not something that I think a lot of people think about a lot, because maybe contrary to popular belief, when you're insuring a house, you're not insuring the fair market value of the house, what someone would pay you for it. You're insuring the replacement cost of the house. And that's a lot harder to track. You can kind of go on Zillow and get an idea of what your house is worth, but that's not really what they're insuring. They're more or less insuring how much does it cost to rebuild the house. So if you're, added on additions, if you are in an area that's gotten even more expensive to build in, it's definitely something to look at, because you don't want to have your house burned down and then realize, oh, I was actually short on my insurance, because at that point, it's too late. So yeah, it's one of those things, actually, I think the CFP made me a lot more aware of to look for in people, but it is one of those things that a lot of people wouldn't think about, but could be affecting them, even today.
Mm-hmm. Yeah, you mentioned people are typically with their home and auto agent a long time.
Yeah, very long time.
One of the quick ways you can tell if your homeowner's insurance has gone up is if you have a house payment, obviously, and it's escrowed in, and all of a sudden your house payment is escalating up. There's it's a good indicator that
pretty dead giveaway.
Yeah, either your property taxes are going up or your homeowner's insurance, or both in this case. So definitely want to just take a look at that if you're out there today listening. And then if you'd like to come in and sit down with us and do what we call a discovery session, so that we can look at everything together and have more detailed discussion on your specific situation, you can do that by calling 256-937-2010. Again, the number is 256-937-2010. If you're listening to the 30-minute version of the show, this is the first half of it. So if you would like to catch the whole episode, then you're gonna hop out to the Spotify platform or the Apple Podcast platform, and you can catch the whole episode there. Again, we've aired now 365 times. That is just a lot of airings here in the Huntsville area.
Isn't that? Yeah.
Yeah, we like to say we have the longest running independent financial radio show in Huntsville. We're real proud of that. We've been around a while, not going anywhere. So if you'd like to give us a call, 256-937-2010.
With so many worries in life, market volatility shouldn't be on your list. Help ensure your retirement plan is stable and independent of market swings. Just get in touch with Cris Wallace at 256-937-2010. That's 256-937-2010 to start planning.
Quarters, just 25 cents. That's hardly anything, right? But Cris Wallace and his team at WG Financial see quarters a little differently. A quarter is a lot when it's a quarter of your retirement savings. Now, do you want to pay 25% or more in taxes during your retirement? Well, Cris can create a plan to help address that. Now, if the only time you think about taxes is when you file them, you don't have a tax strategy. But it's not too late to get one with the help from Cris Wallace. So act now to make sure you're not paying a quarter, dime, or even a penny more than you should. Call Cris Wallace and his team at WG Financial at 256-937-2010 to schedule your personalized tax strategy session. A quarter saved is a quarter earned. Call 256-937-2010 now. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm may not give tax advice.
If you're pondering the longevity of your retirement savings with questions like, is my nest egg sufficient? Or how long will my retirement funds last? Consider scheduling a session with Cris Wallace. Text VISIT to 256-937-2010. Again, text VISIT to 256-937-2010 now to set up your appointment.
And we thank you so much for hanging out with us today. This is the Rocket City Retirement Show. I'm Luann Fulmer here with Cris Wallace, the Rocket City Retirement Guy, and of course, along with Graham Bauer. And we're just so happy to have you along with us today. Thank you so much for hanging with us. So, now that the new year is actually getting closer, I can't believe it, but it's like the election happened and then boom, it's the holidays. November's here and we're looking at Thanksgiving and we're looking at Christmas and we're going to be ringing in the new year, sooner than we even planned. So hopefully 2024 went okay for you, even though we all had a lot to kind of go through and endure. And we're looking forward to 2025. But end of year, there's always some things that we need to do before we actually toast in the new year. So, Cris, why don't we, you and Graham are going to talk to us about what we can do financially to set ourselves up for a wonderful 2025. So tell us what it is that we need to be focusing on here year end.
Well, right now, just a couple of things that just kind of pop in my mind. First of all, is if you're going to do Roth conversions, those actually have to be done by the end of the year. If you're going to make contributions and you're close on the modified adjusted gross income limit, then you can just wait until tax filing, at that point to see if you're eligible to make a contribution. But conversions have to be done by the end of the year. And our advice is don't wait till the last minute to do it. I mean, you're not going to do yourself any favors trying to convert on 12/31. So just make sure you're planning accordingly. And there's a lot that goes into a retirement plan in general, Luann. And I think when people think about retirement planning, I think their mind automatically goes towards investments. But there's a lot more that actually goes into retirement planning. We are also right in the middle of, open season and, the annual election period, rather. And so healthcare is a big deal. So there's people that are still working. They're getting towards the tail end of their career. Should I do a different health plan? And is this the time to change life insurance? These are all things that go into a retirement plan. Your legacy plan. How do you want your assets to pass along to your heirs? Long-term care. Should I have long-term care right now that I don't have anything? Should I get it? If so, how much is it? How much should I get? 70% of people out there listening to the show today are going to need some level of care. It doesn't necessarily mean that 70% are going to end up in a nursing home, but 70% of people will need some assistance out there, whether they're at home, assisted living, or actually in a skilled nursing facility. So it's a good time of year to really start thinking about the retirement plan, some things you need to address. And I would probably say get a jump on it before 2025. I know that our calls tend to go up a little more so in January, February, just because I think it's probably that New Year's resolution. Hey, I want to get my retirement planning in order and let's, give them a call. And well, it's never too early to start. And I think, starting at the tail end of the year is a great time because there may be some things that you could course correct on early in the next year. Because if you don't call until say February, well, you've already missed 2 months of the year. And we know there's some changes coming up next year, especially if you're 60 years old to 63. There's some extra catch-up contributions that you can put in. So looking at all that, I think it's a great time to start taking a look at the end of year planning.
Now, if someone were going to, start, okay, right now, let's say, here we are, just, 8 weeks probably from the new year. What do you think they should start doing, Graham?
Well, I think that, if you're going to start looking at the end of the year, probably the best place to start is looking at your goals and seeing where you are in relation to that. I know a lot of people like to make New Year's resolutions, I guess I make New Year's resolutions every year, but to be perfectly honest, I don't know that I've ever kept to a single one. So, in a lot of ways, that's probably why someone comes in and works with a financial advisor, because you might have those financial goals. Like I make a New Year's resolution, but if I don't have any accountability for that, there's a good chance I'm, not going to get that done or going to forget about it. It takes a lot of intentionality. So like Cris was mentioning about us getting a lot of calls from new people towards the beginning of a new year, we also get a lot of calls from existing clients towards the end of a current year. And a lot of that has to do with the fact that, we'll be working on a Roth conversion plan or saying, reach out to us during your annual election period and we'll help you pick through your options and things like that. But a lot of people just kind of want to brush up towards the end of the year. So a big part of that is, we have these meetings throughout the year, we set some goals, and then starting out at the end of the year, figuring out, okay, where are we in relation to these goals? What do we need to do to reach these goals? Or, saying, hey, we did a good job. We did the goals that we wanted to hit this year. And then we start fresh next year, set some new goals and look at those. So I think that that's one of the best things you can do. I guess that's maybe more geared towards working with a financial advisor, which I might be partial to for something like this. But, I guess if you're a younger individual and, you're kind of in more of the accumulation stage of your life, it's also a good time to evaluate your goals and maybe see if you need to set some, take a look at your spending, take a look at your income that's come in. I think for a young individual, really looking at inflows and outflows is one of the best things you can do, because I can speak for myself and say it's easy to just let money slip away and not know where it's going. So that intentionality is important no matter what age group you're in. But I think really a goal-oriented approach of, trying to reach that next step, get to that next stage is what's really important.
Cris, what about healthcare?
What about it? No, I'm just kidding.
You tell me, really end of year, what should we be thinking about?
Yeah. So I mentioned right now, we're kind of in the midst of the annual election period. And kind of as Graham mentioned there, we've had a couple people reach out to us. Hey, which type of plan should I choose? And should I, if I'm north of 65, should I stay on my workplace plan or should I go with Medicare? These are all the types of considerations that you need to look at. I do know that if you've got like a Part D prescription plan, Part D for drugs is a great way to remember that. This is the time you definitely want to review that. And you want to do that because the price of drugs change, the price of plans change. And this is a great time for you to save money. I'll use my father as an example. He was able to change plans. I didn't change his plan. I try not to work a whole lot with my own family, but he did change his plan and was able to save. I think he told me he saved a total between his Medicare supplement and his Part D prescription plan. I think he saved somewhere around $1,100 a month. So
what?
I'm sorry, not $1,100 a month.
Okay.
11. Yeah, I saw Graham's eyes. I saw Graham's eyes jump up as soon as I said that, and then you yelled in my ear. So it's $1,100 a year, which is a lot. I mean, you're talking nearly $100 a month. So that's a couple of date nights out to Chick-fil-A nowadays, because it costs $50 every time you go with two people, it seems like.
It is.
So just a couple of things to keep in mind. So this annual election period, this is when you can change your Medicare Advantage plans. You can also change your Part D as in drugs prescription plans. With the Medicare supplements, they don't fall underneath the open enrollment guidelines and the annual election guidelines here. The Medicare supplements you can actually change anytime during the year. So I think a lot of people get that confused. And when you're looking at your Medicare supplement plan, you may receive a couple of price increases in a year. Well, if it goes up too high, you can actually change that anytime. So just kind of keep that in mind. That's just stuff we remind some of our clients as we're working with them is, we have the opportunity to change that in March if we want to. So it doesn't necessarily have to be done during this time of year.
Okay. And then, of course, we have to address taxes, right? End of year taxes.
Oh, for sure. And I'll let Graham kind of chime in a little bit here, but we know taxes will ultimately be one of the largest expenses we pay in retirement, if not the largest. So understanding how to reduce and optimize and take advantage of certain things we think is really, really important. It looks like, and we don't know for certain, but we now have a new administration going into office, and the Tax Cuts and Jobs Act was set to expire and actually still is set to expire at the end of 2025. But I think you have to wonder, and I want to get your opinion on this, Graham, just to see what you think. Do you think they'll be extended, the TCJA?
I tend to think that they will. To be honest, I think it is so politically unpopular to raise taxes ever that no administration is going to be the person, or want to be the person rather, to say, okay, we're going to do that. Because obviously, you know, we have monetary policy and we have fiscal policy. These are two different things. So, you know, when people are looking at the feds and looking at Jerome Powell and interest rates, that's a totally separate thing. They don't get to decide where our tax rates are. So our elected officials are the people deciding who our tax rates are, which is a good thing. It's great that we get to elect our officials, but it does add that extra element of you want to keep the people happy. And if there's one thing that our clients don't like, that, you know, I don't like paying taxes, but I think the average person really, really doesn't like paying taxes. Yeah. And so raising that in a lot of ways, I think feels like political suicide. So I think they will get extended. You know, I'll be curious to see if they get extended and everything is exactly the same, or if we see some random changes here and there to, you know, I know people complain about the property tax limitations on itemized deductions and things like that, but I do think the tax brackets will be.
Yeah, I tend to think they'll be extended as well. I don't see how they can go any lower at this point, unless the tariffs that Trump has talked about generate enough income for the government, which then allows for a lower tax rate, which is basically more net money in our pockets. So but I don't see how that can get done in a year.
Yeah, they would have to work, those tariffs would have to work really fast before that deadline. So yeah, I agree with you. I think, you know, for a long time, I remember we had a conversation with another advisor about this one time, where he was talking about even like, you know, Japan's economic theory where taxes keep going down there. But if you look at Japan now, they're not in a good spot right now. And, you know, when you have aging population and those taxes keep going down, you would need, something like a tariff to supplement that income, because I don't know if anybody's heard, but we have quite a lot of debt in the U.S. So when, you know, taking a very classical approach to paying off debt, you need income to do it. So past a certain point, it probably gets tough.
Yeah. So I tend to think like you. I think they're going to be extended. So we'll see what happens there. Mm-hmm. But taxes, we feel like, you know, are controllable to a certain extent. You know, if you look at a situation where a family's got Social Security and they have a pension and they have all pre-tax money, there's a certain point where there's not a lot you can do. But if you have multiple sources of taxable income, like say, for example, you have an IRA, a pre-tax IRA, you have a Roth IRA, you have a capital gains account, then I think at that point you can start mixing and matching some of the income and can kind of help yourself. You can also help yourself, and we talk about this a lot on the show, with your Social Security claiming strategy. If you're willing to wait a little bit longer on Social Security, potentially look at some Roth conversions, then when you're taking Social Security, we know that Social Security is taxed more favorably, so that tends to put people in a more tax favorable situation. So I think taxes, they are what they are. The tax code is what it is, but I think there are ways to utilize it to your advantage in some cases. And I think that's kind of where we tend to, offer a lot of value. Is we're not CPAs and we don't, quote, give tax advice, but we can tell you where there's some, advantageous ways for you to look at taking income for sure.
Yeah. And, I think we might get into this more in a bit, but when you're thinking about taxes too, you do have to think long-term about it. Thinking about something like a Roth conversion, it can be very hard for people to want to do something like that, because that means paying a lot of taxes today, even if it will likely result in less taxes down the road. And for a lot of people, like in the scenario you mentioned, you got a lot of pre-tax money, you have some pensions, so you still have a lot of income coming in. That's a great scenario. And if you wanted, you could just kick the can down the road and let your kids pay all the taxes. Now, is that going to be the most tax efficient thing to do? I would say almost definitely not. You're probably going to end up giving Uncle Sam a lot more of your money than you would otherwise. But you'll never see that happen. You'll never feel the effects of paying those taxes. So if you wanted to kick that can down the road, you could. But I think that really, it almost gets into like, do you hate taxes or do you hate paying the taxes? Do you personally hate paying the taxes? Because we can tell you, if you do this, you're going to pay more taxes. You're just not going to be alive to see it. You're going to be 6 feet underground and your kids will be writing the massive checks. And again, for some people, that might be totally fine. But, it may be a little inconsistent with some people's messaging. And that's just where it gets into really almost more of a psychological decision for so many people.
Yeah. Yeah. I think also that you can do some charitable trust planning on the back end of an IRA as well, that I think a lot of people don't consider, but which we think is a great thing, especially if you're charitably inclined and you have charitable intent. There's a way to do that, and you can kind of stretch out beyond that 10-year rule as well if you use the CRT correctly. So, so Luann, I mean, taxes are important. It's important to look at all your options and know how to best utilize the code.
Are there any other big considerations we should be thinking about end of year?
Yeah. So if you've already started taking RMDs, you'll want to go ahead and take your RMD by the end of the year. That's something that I didn't mention earlier that I just made a note of is you'll want to make sure you take the RMD. If it's your first one, you technically have until April the following year to take it, but then you're going to take 2 in that same next year. So like if this is your first year, you could stretch it into next year, but then you're going to have to take 1 by April and then you're going to have to take another one by the end of the year. So that means you're taking 2. So that's not normally the most tax efficient way to do it. Usually what the most people we work with, they go ahead and take it in the year that they turn 73. If you're in the bracket where you were born in 1960 or later, your RMD is not due until age 75, so you still don't have to worry just yet. So taking the RMD by the end of the year, checking on your liquid reserves, I think is a good thing. Just kind of find out where you're at liquidity-wise. Make sure you're not building up an excess amount in checking your savings, because we know that money that sits in savings with the interest rates that are being paid today, even if it's only about 3 or 4% on a couple $100,000, that's a substantial amount that's getting taxed at your ordinary income rate. So just be mindful of that. And then some charitable giving. If you're doing charitable giving, that'll need to be done by the end of the year as well. If you use a qualified charitable distribution as a way of giving direct out of your IRA, that really needs to be wrapped up by the end of the year. And you have to be 70 and a half to be able to do that. So don't think that you can be 60 and do a QCD because you can't. You got to be 70 and a half. So a lot of our clients are doing that, given to their charities of choice and also their local church as well.
Wow. So much information here. And we always say, you don't want to make these financial decisions without really understanding the full impact of what they're going to do on the other pieces of your retirement plan, which is why you need that plan. Cris and the team at WG Financial Group are offering a chance for you to come in and see them complimentary. All you have to do is pick up the phone, call, or text the word visit 256-937-2010. That's the way to reach out to Cris. Get this discovery visit complimentary. 256-937-2010. Call or text the word visit. And we thank you so much for joining us today. You're listening to the Rocket City Retirement Show. I'm Luann Fulmer here with Cris Wallace. He's a certified financial planner, financial advisor, and president at WG Financial Group. And then Graham Bauer, who is a relational advisor at WG Financial Group. And he's recently taken the test of certified financial planner, but we can't give him that title yet.
Not yet.
Okay. But anyway, it's very exciting time that we're talking about today. All right. So I want to move on to rebalancing someone's retirement portfolio, doing that before it's too late. Why? I guess first let's talk about why is it important to rebalance?
Well, your portfolio, and let's just keep it really simple, just talk stocks and bonds for a second. Because the equity markets have done so well over the last 15 years, your portfolio can get out of balance. So if you're near retirement today, and then 15 years ago, you went and sat down with a broker and they sold you some A-share mutual funds that really cost you to get in those funds, and then they never rebalance. You just kind of sit there, which is what we often see. We see a statement from brokerage firms where they've been in the same funds for 15 years. Because the equity markets have done so well, it's very possible that you could be as high as 70, 75% equity and say 25% bonds. Well, with you getting ready to retire, just say if it's this year, or next 1 or 2 years, and all of a sudden your equity exposure's crept up to say 75%, you may have said, okay, well, I've done really well. Well, yeah, you have because the portfolio got out of balance and now you're really heavily exposed. And if the market decides to fall off a cliff, go in a recession, there's a war started overseas, that portfolio could take a pretty big hit. So rebalancing is really important. That's something that we actually do on a quarterly basis. We just we're mindful of that with the clients that we work with. We set up a risk profile for a client, and then we're just going in on a quarterly basis. And our managers are actually rebalancing those portfolios just to kind of keep you set where you should be in terms of risk tolerance.
And one quick thing on rebalancing there, because I think the way you explained it is really good and a lot more in line than maybe some people might think of rebalancing. Because what I hear a lot, well, I wouldn't say a lot, but sometimes from people is thinking that rebalancing with an advisor should be making drastic changes regularly. Like, oh, well, we've been in the same kind of risk tolerance for, a year now. Should we be rebalancing to make this different? And that is not necessarily the point of rebalancing. That can be a type of rebalancing if you're saying, okay, we're going to take on a little bit more equity exposure. But when we're setting up a financial plan for someone, we're not setting it up with the assumption that we are going to go 100% stock, 20% stock, and 30% stock rebalances in the same year. Like, that's just not sustainable. It's not smart. And that's what kind of goes into market timing. So I think that becomes a common misconception with people thinking, oh, are we really rebalancing? Because I still see a similar amount of stocks and a similar amount of bonds. It's like that is actually kind of due to rebalancing to keep you inside that risk tolerance that you're comfortable in, that works with the plan, and that's, keeping that safe and also allowing it to grow in retirement.
Awesome.
Yeah, I think there's a misconception for some people. They think financial advisors they know what's going to happen in the market. And
I wish. I wish, man.
That's funny. I wish. No, so do I. I think there is this misconception is, I've sat down with people and they say, oh, you know what's going to happen in the market. And I'm like, no, not always. I mean, there's some decent indicators that you can kind of pay attention to, but there's certain things you can't predict. And I think this is where you have to have a plan. You have your mix set appropriately for the long-term plan. And Graham, you mentioned like 80% stock to 20% stock. I mean, that's a radical shift, in a plan to do that. That's what I call a radical shift. And when you're building your plan, you really shouldn't have to make radical shifts. If it's done right, the data's entered correctly, the plan is developed correctly, you really should. You can probably float, maybe 10% either way equity, as long as you're having that conversation with the client and say, hey, it looks like things are a little bit more rosy on the outlook. Let's take our equity exposure up maybe 10%, but not changing it 50 to 70%, I think is not good. But there are people that think that you're supposed to know that. And that's not, we're planners. We build the plan. We're not stock pickers. And I don't know what the actual stats are, but it's like 70% of mutual fund managers, or 70 or 80% rather, tend to fail more often than not and beating the market long term. So it's just not the goal of ours. We don't want to put people at risk like that.
No.
Yeah, I think there's a feeling just with humans in general that you need to always be active in certain things, as far as like, if I'm not being incredibly proactive about this, it's not working correctly. Yeah. And when it comes to long-term investments, you should watch it. You should do some rebalancing. There are definitely times where you might take your allocation and switch it around a little bit. But if you have, met with a professional, created a good plan, then your goal should not be hyperactivity. That's not a good sign in most cases. No. But that's kind of counterintuitive to how I think a lot of us feel about something. Like if we felt like we were not being productive at work, we would probably think we're doing a bad job at work. But, in a lot of ways, when we're talking about passively investing, keyword passive, you want to still be proactive when you're working with someone, but not overly active, not in there all the time monkeying around. And we're certainly not the person that's going to call you at 3 a.m. saying, you have to buy Apple at market open tomorrow. It's going to go up 1,000,000%. It's not what we're doing.
Well, I think it was Warren Buffett who said investments are like a bar soap. The more you handle them, the smaller they can get.
Oh, yeah. Yeah, that makes sense.
So, it's a great quote. I said that the other day in front of somebody, and I could not remember. I just had to look it up online. I knew that I didn't make it up. I make a lot of crazy stuff up, but that was a good one, and I didn't make it up. And I Googled that before, I said that here. But, it was Warren Buffett that said that. And I think that's what can happen with just with a portfolio. And if your portfolio doesn't get smaller, in a lot of cases, it doesn't get as large as it could get if you're actively in there, trying to time the market and all of that. Because all it takes is a few of the big days missed during the year, and you'll totally rip your performance apart on an annualized basis. So yeah, rebalancing's good, just not being, I think the term that I like to use, Graham, is tactically passive.
Mm-hmm.
So I think it's okay to be, I don't think you should be all the way passive, because if you're all the way passive, you're probably not doing the rebalancing that we're talking about. I think it's more about being more strategic about it, and maybe calling it something like tactically passive is kind of the term I like to use.
Well, that's what I was going to ask you. When you don't rebalance, then you're being very passive, and then a lot of things can happen.
Right. And then you have that situation I described where the market's
exactly.
been doing well for the last 15 years, and now your equity exposure is way out of balance.
Yeah.
And you're getting ready to retire, and then all of a sudden the market goes into a recession, and you're like, wait a minute, I lost 30, 40% of my portfolio. I thought I was more conservative. Well, you were 15 years ago, and now things are out of balance. Right. That's why it's good, in my opinion, to get a second opinion. I always like to say, whether it's us or somebody else, just give them a call, give us a call, and we'll do an analysis on the portfolio. We'll look at it. We'll see how it functions within the plan long term, because that's really the most important part. I don't care whether or not you tell me you want to be aggressive. I mean, I do care. Don't take that the wrong way. I do care. But you can tell me you want to be aggressive, but if the plan is telling us that you don't need to be as aggressive, and then it works better to be a little less risky, then we have to start listening to that a little bit. Or, maybe you're better served to do it on your own. But, we'll do an analysis on that. We'll take a look at the fees. I think that's another area of a portfolio that I see that people, they don't realize they're paying as much in expense ratios within their investments. And I've seen this with advisors that have, radio shows and even TV shows, and we'll do these analysis, and it's like, whoa, you're paying on average 0.6% in expense ratios. And on top of that, now you're paying the advisor, say 1.5% on top of that. Now all in together, you're north of 2%. Well, we look at that. We go over that in the analysis. We'll take a look at the risk, take a look at how the plan functions long-term. That's just part of what we do.
So, all right, I'm looking at all the list of questions that I had here for us today. And you mentioned a rule of thumb for rebalancing. How often was that?
So we do it quarterly. That's how often we do it. I would say at bare minimum.
At bare minimum.
Bare minimum, it needs to be done once a year. Or let's say you had a spouse pass away. Then I think you have to start taking a look at your situation. That would be what we'd call a major event.
Yeah. Yes, of course.
Yeah. The other thing that you could do is, and this is what I would call a little bit of market timing, but let's just say that the market does correct. I don't know. Let's just say the S&P drops 35%. I think at that point, you sort of kind of have to ask yourself, should I rebalance at that point? Depending on your plan, should I shift my exposure to maybe slightly more equity heavy? Should I look at the duration within my bond funds? I mean, if there's a major market, so take for example, like COVID. This is a great example. The market fell off a cliff and the Fed's crash rates to zero at that point. That was a prime opportunity to do some rebalancing. That was also a prime opportunity based on where the monetary policy was shifting, to take a look at the bond durations. So I think those are some things you can kind of look for. Again, don't try to market time, but if those quick major events happen, a death or a major market like flash crash, then you can take a look at some rebalancing there.
Okay. Wow. This has been a great show. We've got into a lot of good stuff. Thank you both, Graham and Chris.
Yeah, it's good to have Graham back. Graham he's an easy person to talk to. I can tell you that. He and I are big NFL fans as well. So when we're taking trips together and such, it's always good conversation about NFL, but he's also pretty intelligent when it comes to this stuff as well. So it makes for good radio talk as well. So again, if you would like to come in and sit down and do a discovery session, we would be glad to do that, to do an analysis on that portfolio, look at your fee structure that you're paying, and to really just put our best foot forward and show you how we think we can help your family along in retirement. Give us a call at 256-937-2010. Again, the number is 256-937-2010. I hope everybody has an awesome and blessed week, and remember to serve every person in every situation with a servant heart.
Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.
Investment advisory products and services made available through AE Wealth Management, LLC, a registered investment advisor. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. Insurance products offered by WG Insurance Services are not subject to investment advisor requirements. AEWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.